What if the financial collapse you fear is never the real collapse at all? What if the markets don't fall first, people do? And what if the same six-stage pattern has quietly unfolded before every major economic reset of the last century, from 1929 to 2008 to the present day, without anyone noticing until it was too late? Today, we're pulling back the curtain on a sequence so consistent, so dangerously repetitive, that once you see it, you can't unsee it. Because the real question isn't will another collapse happen? It's which stage we're already in right now. To understand the six-stage collapse pattern, we need to go back to the early 20th century, a time when America's financial system was expanding faster than its ability to control itself. The Federal Reserve was young, and ordinary families were stepping into a new world of easy credit without understanding what it meant. Behind the scenes, powerful financiers were building the foundations of the modern economy, yet unintentionally, they were also constructing the pathways for its destruction. But here's the twist: every collapse, 1929, 1970 stagflation, dot-com, 2008, and the near meltdown in 2020, didn't start with panic. They started with euphoria. They began when people thought the danger had passed, when the system felt invincible, when the numbers looked too good to question. This is the part most people miss. And it's why collapses always feel like they came out of nowhere, even though, in hindsight, the signs were obvious. The story of this pattern begins with stage one, the hidden origins. Every financial collapse begins long before anyone realizes it. It begins in the shadows, through decisions that feel harmless in the moment. In the 1920s, the origin was margin loans, allowing everyday Americans to buy stocks using borrowed money. In the 1970s, it was money printing, created to cover war costs and broken promises under the gold standard. In 2000, it was technology speculation, with startups valued at billions without a dollar of profit. In 2008, it was subprime lending, disguised as safe investments. Different eras, different triggers, but the same psychology. We believe we've invented a new kind of prosperity. That belief is the spark. But the pattern only grows stronger in stage two. Once the origin takes hold, markets enter the everything is working phase. You see rising charts, rising confidence, and rising risks hidden beneath rising optimism. This stage feels good, too good. The dot-com era called it the internet revolution. Today, it might be called the everything bubble or the AI supercycle. In every case, the story is the same. Investors chase momentum instead of fundamentals. Governments take credit for success they didn't create. And the public believes this time is different. But here's the uncomfortable truth. It creates the illusion that the system is stronger than ever, when in reality, it is becoming increasingly fragile. Because during stage two, everyone begins thinking in the same direction. And when billions of dollars move with the same emotion, fear, or excitement, the system becomes predictable and therefore unstable. Every collapse has a moment where the system stops rising. It's that silent moment between the inhale and the exhale. The moment when investors notice cracks but call them temporary. The moment when governments quietly tweak numbers to maintain confidence. The moment when the narrative begins to split. In 1929, the breaking point arrived when the Federal Reserve raised interest rates. Small move, big consequences. In 1973, it arrived when oil prices spiked and inflation stopped being transitory. In 2000, it arrived when overpriced startups began missing earnings. In 2007, it arrived when mortgage defaults ticked slightly higher, but were dismissed as contained. The breaking point is subtle, but it's crucial, because from this moment forward, every attempt to fix the system only weakens it further. The government steps in with reassurance. The central bank adjusts rates. Banks promise stability. Analysts claim the fundamentals are sound. But the pattern continues, and the system moves into stage four. This is the stage everyone mistakenly thinks is the beginning. But no, stage four is simply the moment the illusion fails. The collapse happens fast because everything in stages 1 to 3 built up pressure that had no release valve. Banks freeze lending. Households cut spending instantly. Confidence evaporates overnight. In 1929, markets fell 12% in a single day. In 2008, Lehman Brothers collapsed like a domino. In 2020, global markets plummeted in the fastest crash ever recorded. But here's what most people forget. The collapse isn't the end. It's the moment the true damage finally becomes visible. The fallout is where the human cost becomes real. This is where businesses close, unemployment spikes, savings disappear, currencies weaken, and political anger reaches boiling point. It is the stage when society begins asking questions. Why didn't anyone stop it? In the 1930s, fallout created the Great Depression. In the 1970s, it created runaway inflation and social distrust. In 2008, it triggered mass foreclosures and shattered faith in financial institutions. Fallout is painful because it exposes everything we ignored, everything we denied. Because after every fallout, leaders attempt a solution, stage 6. Every collapse leads to reforms, promises, and rescue plans. But historically, the fixes almost always address the symptoms, not the cause. In the 1930s, the government tried stimulus without fixing underlying debt cycles. In the 1970s, rate hikes crushed inflation but also crushed growth. In 2008, bailouts saved banks but never reformed the incentives that caused the crisis. And in 2020, stimulus injections protected the system short-term, while inflating new bubbles long-term. This is why the six-stage collapse pattern keeps repeating. Stage 6 never closes the loop, it only resets it. What stage are we in today? And the predictions that analysts are too afraid to say out loud. So what stage are we in today? To answer that, we have to look at the data, not the headlines, not the political speeches, not the market hype. Real numbers. Because numbers don't lie, but people do. Here's what the pattern shows. U.S. household debt is at its highest level in history, crossing $17 trillion. Credit card delinquencies are rising at their fastest pace since 2008. Corporate debt is larger than the entire U.S. economy. The government's interest payments alone are approaching $1 trillion per year, more than the entire budget of many federal departments combined. And the stock market? It's at valuation levels comparable to 1929 and 2000, the two most famous bubbles ever recorded. But here's the real bombshell. The financial system today is built on more leverage, more complexity, and more dependence on artificial liquidity than at any point in modern history. That means the chain reaction, if it starts, will move faster than any collapse you've seen before. To understand how close we are, let's map our current world to the six-stage collapse pattern we explored earlier. The origin of the next collapse isn't hidden. It's in plain sight: unrestrained debt, asset bubbles, a financial system addicted to low interest rates, and an economy propped up by consumer spending fueled by credit instead of wealth. Plus, the biggest origin of all, belief. Belief that the central bank can always fix it. Belief that technology will always drive growth upward. Belief that recessions can be prevented with the click of a button. Every collapse begins with mistaken confidence. And confidence today is higher than reality deserves. Between 2020 and 2023, markets didn't just rise, they exploded. Why? Because governments around the world printed over $20 trillion in new money, creating the largest artificial boom in human history. Stocks rose, crypto rose, real estate rose, commodities rose. Even unprofitable companies soared. This wasn't organic growth. It was a sugar high, a stimulus-driven rise exactly like the speculative booms of the 1920s and early 2000s. And as history shows, sugar highs always lead to crashes. Here's where things get alarming. The breaking point has already arrived. You can see it in rising interest rates, because for the first time in decades, borrowing is expensive again. You can see it in failing commercial real estate, office buildings losing value, cities hollowing out, landlords defaulting. You can see it in shrinking savings, rising defaults, and wages that can't keep up with inflation. And you can especially see it in government debt. When the cost of servicing national debt grows faster than tax revenue, the math stops working. It's not opinion, it's arithmetic. The breaking point is here that it's quiet, but it's visible to anyone who knows where to look. Now, let's be clear, the collapse hasn't fully happened yet, but the conditions for it are already set. If stage 4 unfolds the way it historically does, here's what it will look like. Not hypothetically, but based on past patterns. Stock markets will drop suddenly, not slowly. Companies built on fragile debt will disappear almost overnight. Banks will restrict lending, accelerating the downturn. Consumers will slash spending, killing growth. Governments will panic, insisting everything is under control. Investors will flee risky assets first: crypto, tech, speculative stocks, then eventually move to safety. The trigger could be anything: a major company defaulting, a geopolitical shock, a liquidity squeeze, or a credit event in the bond market. But the trigger isn't the cause. It's the spark that ignites what was already dry and ready to burn. Fallout is where the real consequences unfold, the part people feel in everyday life, not just in stock charts. If the pattern continues, fallout could include rising unemployment as companies attempt to survive, housing markets freezing as buyers disappear and loans tighten, pension funds losing value, putting retirements at risk, local governments cutting services due to revenue shortfalls, inflation returning or flipping into deflation, depending on the severity of the downturn. But the biggest fallout isn't economic at all, it's psychological. It's the moment public trust collapses. Trust in leaders, trust in institutions, trust in the financial system. In every historical collapse, fallout reshapes society. It creates new political movements, shifts global power, and forces people to question assumptions they believed were absolute. We're not there yet, but we're closer than people think. When governments and central banks respond, their goal won't be to fix the system. It will be to keep it afloat. Expect responses like emergency liquidity injections, lowering interest rates again, bailouts for systemically important institutions, debt restructuring, new stimulus packages, and possibly digital currency systems framed as modernization, but implemented as control mechanisms. The challenge? Every one of these solutions has been used before, and each time, they prevent immediate disaster while planting the seeds for the next one. Stage 6 doesn't end the cycle. It simply restarts it. Unless, this time, something different happens. Unless people recognize the pattern early enough to break it. Which brings us to the final message. Every collapse is predictable in hindsight because the pattern is always the same. The shock isn't the crisis, it's the ignorance. The early stages of collapse always look like prosperity. The danger isn't when things fall, it's when people stop asking questions. You can't control the system, but you can control your awareness. The people who survive resets aren't the richest. They were the ones who understood the cycle before others did. We've seen the pattern that we know how it starts. We know how it ends. But the real mystery is this. Are we living through the final calm before the storm, or the first tremor of a new reset? Only time and awareness will decide. If you want more deep dives into history, markets, and the hidden mechanics that shape our world, subscribe, share this video with someone who needs to see the pattern. And stay curious, because understanding the cycle is the first step to surviving it.